This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
We got an unemployment report that didn't matter very much. On this week's show, we'll talk about that, what looks good and bad for later this year, and an update on a holding from our portfolio. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the portfolio managers here on the team. And, the market has been making all-time highs, but the expectations for rate cuts and arguably what had been driving this market rally since November, which was the expectation for a lot of rate cuts, well, those expectations for them has now been, muted since we've had some mixed economic reports, meaning the economy has been stronger than expected. And inflation remains a bit stubborn, albeit still improving. And with reports continuing to give mixed messages, along with a litany of testimony and public statements from the Fed officials who are just really out there very clearly, I think, curtailing our expectations for both the scale and then the timing of these rate cuts. Well, we're seeing the market still rallying despite this trepidation. But now this week, to conclude a really rambling thought here, this week we're now moving past earnings season, and we're getting to digest the start of February data to see if this January, all that economic data we had in January, which gave us reason to pause, the January data which said that inflation is not conquered yet, that we are not going to get as many rate cuts as we thought. Well, now we're going to get to confirm whether or not that was a head fake in January and we'll continue on our merry way, or if really we're not as well off as we were. Can we get back to that game plan for this year that launched this rally off a sell-off in September and October, and then market zoomed in November and we started cooking all these rate cuts? Or are we going to change the narrative altogether? Because right now, the Fed has been acting as this lead blocker, blocking its way through the offensive line since then. But the plan might have been flawed. And we're going to start to see now in the coming weeks a long series of data points, whether or not that we're back on path or whether we're going to have to punt here. Of course, a sensible conclusion and a wise person here might look at this and it's just this ridiculous run-on sentence and conclude, well, maybe the markets are climbing higher because the economy is doing well and that earnings are doing better than expected and that estimates are too low. That's a reasonable takeaway. It's a different point. It's not what the markets have been saying, but it's a reasonable takeaway here. I held off this week on prepping for the podcast a bit longer than usual because I wanted to digest that the February unemployment or employment report that we got Friday morning first, but it was a waste of time. It turned into really mostly a nothing burger of a report. Productivity was good in the report, but basically flat at a good rate. Overall unemployment rate was 3.9%. The participation rate was flat. Really nothing to change here in this report. Didn't change many outlooks very much, although the market reaction was generally positive. It moved futures from negative to positive, and the markets were doing well Friday morning. But for the rally to continue, it's going to have to be sold in a different way. We took off late last year in anticipation by the street for what they had banked in for 8 rate cuts this year, starting in March. And that narrative now is shriveling up on the vine. But the markets continue to run a different story, one based on economic growth and also on cash. There is a lot of cash in the investment world parked on the sideline, and there's still a lot in the pockets of consumers and also on the balance sheets of many big corporations. In fact, you're seeing some nice returns coming, or maybe the juicing of quarterly profits, because corporations are disclosing pretty big numbers in net interest income. Now, an important focus really, more important than thinking about week-over-week employment data, is when you're thinking about your own money, you got to think a bit about what the motivation for all this money flowing into the markets recently, what's moving that in. Because you may have some money parked on the sidelines yourself, that's happily earning somewhere in the mid-single digits in yield in a money market, as so much has. But while these stories may be evolving, the consensus belief is still that interest rates are going to be lower in the future. There's always the possibility that they're higher, but the overwhelming consensus is that at some point in the future, it varies whether it's going to be start 3 months from now or maybe 12 months from now, but interest rates are going to be lower. And capital, in general, doesn't want to be caught in money markets when it had the opportunity to lock in higher yields, either today in bonds or lock in equity ownership at prices today that it generally believes are at a discount to the value it may command at lower interest rates at that point in the future. The money on the street doesn't want to be the last one standing in cash when the music stops, or maybe it's that the music starts again with a new cycle of interest rate cuts when they do one day arrive. But of course, this doesn't mean you should chase the lemmings, and that this is not a story that you should be ramping up equity exposure as the market continues to make new highs. In fact, today is actually a great day to revisit your allocation, how much exposure you have to risk, and consider maybe taking it down, even though we have a cautiously optimistic view on the markets. Don't overdo it now. Now is a good opportunity to say, well, maybe I can move some to the fixed income side at much or a relatively safer allocation portions with yields in the mid-single digits. Bond yields have been overshadowed by this stock market that's been returning such great returns over the last year. And bonds back in 2022 were selling off right alongside the equities. So, they're easy to ignore. But while I can make the case for why stocks may continue to do well here, they're also selling at pretty high valuations off of perhaps lofty estimates for future earnings. We're going to talk about a stock later on where we talk about maybe that the estimates are a bit too low. But generally speaking, the market ain't cheap here. And bonds, meanwhile, are offering yields that you can lock in for 4 years, 5 years, 10 years, pick your poison. There's reasons to that too. But they're offering yields in the mid to high single digits, which you can lock in for quite a few years. My point isn't to rush headlong into stocks after 14 months of relatively strong returns overall, but rather be mindful of perhaps just leaving too much in cash, which seems comforting because you're getting that 4 or 5, 6%, whatever, money market today, wherever it is. But, you could find yourself in 6, 12, 18 months or whatever, sitting there at suddenly much lower interest rates. This is the very short end of the yield curve. And yields on bonds as well as prices on stocks may be far less attractive then than they are today. I still have concerns that keep me wary enough, especially if we do not get rate relief. So you don't blow out of all your money market, especially that which you need for spending over the next near future, and throw it into the stock market. I mean, things that get me concerned right now is there is $1.2 trillion in debt maturing on commercial real estate over the next 2 years in the United States, according to the Mortgage Bankers Association, $540 billion of which is this calendar year. And while we keep seeing headlines about low occupancies affecting many areas of CRE, it's the balance sheet side that really ultimately could be a problem, and a problem that could creep further into the financial sector. I mean, we've seen some drama again recently in small and regional banks, right? Because they're going to have to take, in some cases, big write-downs, write off the value of their loans that they're carrying, and increase the reserve they're carrying due to their exposure to this commercial real estate debt. Now, if these commercial enterprises, who may be also suffering from low occupancy, are forced to refinance as these bonds mature, they're going to reissue these bonds at interest rates that are 5 or 6 or more percent perhaps higher, if they can get financing, 6% higher than they're already carrying, then they're quickly insolvent. Imagine if your mortgage expired and you had to go get a new mortgage to carry the existing debt there, and it's 6% higher suddenly, what that does to your household cash flow. On the other hand, so that I can give you kind of a balanced yin and yang here today, we probably will see some rate cuts. The Fed's definitely alluding to that, and they appear poised to also pause quantitative tightening, giving some relief to the longer dated interest rates. And that could give some relief to that commercial real estate, as well as really potentially ignite an important part of the economy in what's already a pretty hot housing market. According to Strategists, more than half of the mortgages in the U.S. right now are currently held at rates below 3.5%. So higher interest rates, therefore, don't affect a lot of people, but it has some effects on when most of the people are locked in below 3.5% and prevailing rates are much higher. They're unwilling to move. We continue to see existing home sales in this country at historically low numbers and very low inventory, while new home sales and new permitting continue to absolutely rocket in both numbers and in price. Basically, they're selling everything that they can build despite higher interest rates because so few folks are willing to sell their existing homes and give up their mortgages, which are below 3.5%. It may largely limit the market to those that either don't have mortgages or those that have to sell for various reasons. People passed on or they can't afford their mortgage, whatever it is. Existing home sales usually don't move unless they have to. Maybe they relocate in their job. Those with the mortgages otherwise might decide to wait out a bit longer. Maybe they did retire, but maybe they're going to stay in their community of choice a while longer before ultimately heading off to a warmer climate somewhere. The demand is still robust, but lower interest rates really may ignite some strong activity. And that has an effect maybe of cooling some of the housing market. If you have a lot more inventory come on because people are willing to sell existing homes, well, that isolated would alleviate some pricing pressure. But that would likely really be overshadowed and unmatched by the ability for people to afford more home at lower interest rates, as well as the increased profits that it would ignite. Because today there are some real headwinds in that broader housing economic space from the home builders who are selling a lot of homes, but their margins are impaired a little bit because they're basically, if you see them offering teaser mortgages or they're buying down your mortgage, well, basically the home builder is paying points on your mortgage application for you to entice people to buy their new homes. But you also see lessened demand for all the goods and services that would otherwise be stoked if we see these existing homes start selling more, from people from improving their homes, buying new stuff for the homes they just built, the realtors, the mortgage people. There's a lot tied into that economy. Basically, right now for 2024, the race is on. I think this is not highly likely, but if we get completely shocked, inflation picks up a little bit, and the Fed is compelled to wait, not do anything. If we saw a full year without them moving at all rates, well, then the commercial real estate issue could become something really serious. But if they do start to bring relief, and they are very aware of these risks. Yes, their mandate is inflation and focusing on employment, but certainly major financial shocks lead to unemployment. So they're very aware of the health of the banking system. So if they're not inclined to wait too long. Chairman Powell said that specifically this week, that waiting too long is as detrimental as acting too early. Well, as long as they do give some relief, then we could see a bigger tailwind than is even priced in today. Okay, I'm going to take a quick break here, but then I'm going to come back with an updated snapshot on a stock from the portfolio. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from your sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Bit brief here, because a few weeks ago, I think Simon did talk about and go over UPS a bit, but I want to give an update on the progress the company and the stock has been making. This is a stock we own in our portfolios, in our clients' managed portfolio. So that comes with the caveats that there's a conflict of interest here with me benefiting from the stock doing well. And besides, if you're out there picking your own stocks, well, I hope you have a lot of resources at your disposal, and that you never, ever just take an idea from this or any other show or whatever and buy it without a lot of extra added homework. UPS was a featured story in Barron's last week, and in that article titled, UPS failed to deliver in 2023, now it's time to buy, close quote. That is the title of the article. They pointed out that a big hit to stated earnings was that half the costs of a new Teamsters contract. 70% of their employees are Teamsters. There was concern that they weren't going to get a contract. They got the contract, big numbers, but the big part of that was front-loaded and going to be behind them soon. And they go on to say that the Wall Street consensus estimate is that while the stock may not look terribly cheap today, and this is why I'm focusing more on really out earnings, not just this year, because of the front-loaded, because of the cost this year, but that their earnings are going to grow by almost 40% in the next 2 years. And that puts them today at about 14 times that forward estimate, below a 10-year average of about 17 times earnings, with a dividend yield today that's over 4%, and consensus has that dividend expected to grow. Even with the stock now, 16% higher than the lows it made last year. Looking over to a UBS report, UBS upgraded the stock a few weeks ago, and according to them, who raised their 2026 estimate, they raised that estimate above that consensus that Barron's pointed out. UBS has them earning $11.60 a share in 2026. Both that report and the Barron's piece aren't making a call here. It's not about volume, a growth volume. It's all about them being optimistic on UPS and their efforts to streamline their operations and their ability to improve margins. In fact, UBS was particularly optimistic that their guidance was too conservative here, that they're going to improve their margins above 10%, getting to that earnings estimate or beyond. UBS went on to say that they expect improved visibility for the stock later this year as UPS, hopefully, and I say hopefully because I disclosed that there's a conflict of interest here, but that UPS goes on to start to deliver on these goals, giving visibility to the street. That they think is where you start getting a re-rating of the stock later this year as everyone starts to look at the 10-year average multiple to earnings, not a premium to them, but just the 10-year average of a 17 times forward multiple. That gets them to their price goals. Now, the Barron's article does go on to say that it's the economy, stupid. They didn't actually say that, but those were my words for what they were saying. Basically saying that this is definitely an economically sensitive stock. Shipments require demand, both from us buying stuff online as well as businesses shipping stuff to each other. So if there was a softening in the economy, that would certainly impair these results. So beware about that if you are pretty negative on the economy. I'm hearing a lot of people, of course, ask about the election. Well, look at 60, 80, or 100 years of history, what the election does to the economy. It causes some anxiety leading up to it, but then unleashes value typically, regardless of the outcome. So when it comes to UPS or the market in general, I'm not focused on the election when it comes to our portfolios. So regardless of your personal beliefs, probably 80% of you, 40-40 on each side think that's shocking, but don't exhibit your impression of what may upset you as this nasty political year winds on. Don't exhibit that frustration or anxiety by projecting it onto your allocation decisions, to your financial decisions, and the health of your long-term financial well-being. All right, I'm Chase Hinderstein for the Wise Investor Show. That's it for me this week. We do have some big data points coming in the next 2 weeks, so buckle up. We'll be back on here talking about them. And as always, I appreciate you tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.